CBDC, what do you do? And 90% of them say, yeah, at least we do some type of research. Many of them do more. There's relatively few that are live right now. So we have a few like in the Caribbean or in Nigeria. But so many others, we have piloting, China, and so on. And then many others are at least thinking very intensely about the topic, right? So the pipeline is very crowded by now. What CBDC would do, it would basically entail a major change for the financial system, at least sort of in its purest form, without applications and so on and so forth. So, if all policymakers decide to go down that road, it could be useful to eventually understand the potential side effects before going that way, right? So the question we asked in the paper is a very simple one, but it's a very important one. We asked how does CBDC affect financial system, right? And so there's good reasons to believe that there would be some effect, right? So CBDC, one way to use CBDC is sort of an ultimate store of value, right? So basically, it's backed by the government, it's public money, so it's sort of the ultimate store of value. Of course, relative to cash, it has certain advantages, right? And so from that perspective, there are legitimate concerns. So there's also been report coordinated, I think, by the DS, published by, I think, 7 central banks, something like that. That basically also argues, well, carefully, CBDC may amplify the risk of bank fraud, right? So we developed a formal model that tries to shed light on this, and then we're going to ask a few other questions that I probably won't have much time to deal with. But basically, we're trying to look at certain design features of CBDC, such as not only remuneration, which is kind of in the core model if you want, but also something that's been discussed more widely in the public already, which is holding limits, so it can only hold a certain amount of CBDC, and then also something you could label contingent remuneration that again in the interest of virus. So since I have 20 minutes, let me summarize the paper so that you know what you take away today. What we basically do is we incorporate CBDC, I'm going to explain exactly how, in an otherwise pretty parsimonious model of bank runs, right? And so the bank run model we're looking at has certain desirable features that make it interesting to think about CBDC. In particular, it's modeled in equilibrium, so it's in the global games tradition, and also it has endogenous deposit contracts that are set by the monopoly, right? So they're bank sovereigns. So the main result, so the headline result of the paper, is that the relationship between the remuneration of CBDC, so CBDC remunerated in the model, and bank fragility is U-shaped, right? So it's a nonlinear relationship, and this overall effect, this U-shape, it's the result of two holding, right? So you have two things that are going on. On the one hand, you have what we call the direct effect, and that basically just says holding the bank deposit contract fixed, a more attractive outside option, an increase in CBDC remuneration, makes it more attractive to run on the bank, right? If you run on the bank and you can only store whatever you take out of the bank in cash, and then suddenly gives you the option of instead running into CBDC, you know, with some remuneration on that set of variables makes it more attractive to run on the bank, right? So that is sort of very much in line with these concerns that have been already circulated in sort of policy outlets. However, and that is sort of going back to this attractive feature of the bank offering a deposits contract that's endogenous, there's also an indirect effect which goes in the opposite direction. Then basically the bank takes this behavior by depositors into account and reacts to that. And how does it react? It reacts by offering an approved deposit contract to depositors, right? And that basically is an effect that goes in the opposite direction. The bank tries to increase the attractiveness of its own products in an effort to keep consumers in the bank when they're deciding whether to run. Right, so that is, in a nutshell, the main economic mechanism in the paper, right? And then we do a couple of more things. So we talk about these holding limits, we talk about what we call contingent remuneration. We ask for these things, these proposals or mechanisms, so that they could potentially improve financial stability. And then we also have various extensions of the model, which I'm not sure that we're actually discussing that. I'm not going to talk about them much either, but so we talk about the perfect composition there and risk taking on the asset side of the bank balance sheet. Literature, I'll keep it very brief. We did a recent survey ourselves. Then there's literature on CBDC and banks' responses in deposit markets. And it's a literature that's been mainly focusing on credit supply. And here we have the angle of financial stability, right? There's a few other papers that talk about CBDC and financial stability. And last but not least, there's this very big literature on okay, so then a few details about the model. So it's a 3-period model. There's no discounting. Everybody's risk neutral. There's single goods. That's all fairly standard. There's one bank. So the bank is a monopolist, and the bank is profit maximizer, right? On the investor or consumer side, however you want to label them, there's a continuum of investors, and they each endow into one unit of funds, right? And then basically at the beginning of the game, they decide whether to put their money in the bank or not, and then at the interim period, they decide whether to do it properly. Right? So at the beginning of everything, the bank needs to raise funds, and the bank can then use these funds to invest in a long-term project, right? Like in any other bank. So basically, the bank raises a unit of investment funds, and it offers this demand deposit contract that is characterized by the short-term interest rate R1 and the long-run interest rate R2, right? So if you keep your money in the period for one, in the bank for one period, you get R1. If you keep it until the end, you get R2. And then the bank invests that money into this risky project that it has exclusive access to. And this project then returns R times theta at equal to, and premature liquidation and payoff cost. So if the bank prematurely liquidates the investments, that needs some payoff that is less than one. So there is a loss. And so this payoff of the project is the components, where there R is greater than 2, that's just the return on lending, and then there's this important ingredient theta, which is labeled in most of these models sort of the fundamentals of the economy, and that is a stochastic variable on which the consumers get a signal, and that based on that signal they decide whether to run. Okay. Then going back to T equals 0 at the beginning of the game, the bank has offered a contract, and then investors decide whether they want to actually put their money into the bank, or instead they want to keep their money outside the bank. And if they decide to keep it outside the bank, they can either keep it in CBDC or in cash. And so CBDC and cash in this model differ in only one way, and that is the remuneration. So CBDC pays a possibly positive, not negative, interest rate omega. So omega is the gross return per period that you get from all the CBDC, while cash, as usual, pays a return of 1. And so that immediately means that CBDC dominates cash unless CBDC is not right. If we have no CBDC remuneration, this model is just equivalent to an economy without CBDC, right? There's different ways you can think about it. You can also say that having a digital store of money has certain convenience benefit, right? So we call it remuneration, but there's different ways to do it. So that's at T equals 0. Then at T equal 1, consumers or investors, they decide whether to keep their money in the bank or whether to withdraw their funds. And that withdrawal decision is based on a signal SI that all the individual depositors get, which is equal to theta plus an individual specific shock epsilon. And we assume that actually in the limits there's vanishing noise, so this disappears, right? And then whenever there is these interim withdrawals, when investors decide to withdraw funds at T equal 1, well, the bank has to liquidate some of the investments, and that comes at a penalty, as I said, since L is less than 1. Right? That gives rise to strategic complementarity. Right? And so then, in order to solve for the equilibrium in this model, we work backwards, and basically we follow 3 steps in order to tease out the effect of CBDC remuneration on financial stability. So the first thing we do is that for a given deposit contract, we solve for the endogenous probability of bank run, which we label theta star, and that comes as a function of omega, the CBDC remuneration, as well as the deposit contract that is offered by the bank, right? And R1 and R2 are the others, right? Once we've done that, we go one step backwards, right? And then we look at the bank, basically anticipate whatever consumers are going to do at the period. And based on that, the bank will decide what's the deposit contract that I should offer consumers, which is, of course, again, a function of omega, the remuneration on CBDC, right? And then the last step, we put these 2 things together. So then we can express the equilibrium probability of bank run or the bank fragility, this kind of theta star, as a function of omega directly, and of R1 and R2, but no, R1 and R2 themselves, they're functions of omega as well, right? And then if we just take the total derivative of that, we get what I already alluded to in the introduction. There's this direct effect, right? Theta depends directly on omega, but it also depends indirectly on omega through the deposit contract, right? So, which of course the bank takes omega into account, right? So we can decompose this total effect into what I label the direct effect and indirect. Okay. I don't assume that there's too many people here in the room that are intricately familiar with the global games methodology. That's quite a new ground, a bit of new ground that I had to cover myself, writing this paper with my colleagues that are true experts in the field, of course, right? So, but just to provide a bit of intuition, so basically the way you solve for the equilibrium is you establish a failure threshold, right? So we have this variable, stochastic variable theta, that is the fundamentals of the economy, that follows some uniform distribution, and basically you solve for a threshold such that whenever the realization of theta is below that threshold, everybody runs on the bank, right? So there's a slight intricacy here because we look at this vanishing noise, a big limit with vanishing noise, but doesn't change so much. And basically you have this threshold strategy that arises in equilibrium. And then the way you pin it down is basically you find the theta such that depositors are indifferent between staying in the bank and running on the bank, right? And so basically you have this break-even condition, if you want to label it like that in here, where this left side of this equation is the benefits that consumers obtain if they withdraw at t=1, right? Which is basically the return R1, right? That's the short term, if you want, part of the deposit contract, conditional on the bank being liquid at that time. And importantly, here we have the omega there, right? Because with CBDC, you can withdraw your funds at t=1, and then you can put it in CBDC. You can withdraw your funds into CBDC at t=1, and that pays remuneration between t=1 and t=2, right? If this is cash, that's the case where omega is 0, so this thing just disappears. And then on the right hand side, we have the expected return from staying in the bank, which is so this integral basically just restricts the payoff R2 that you get that the bank has promised you, conditional on the bank being solved, right? And so there's this theta in here, and you solve this integral. It's quite specialized, but you can solve it. And then you can work out this theta star that gives you the equilibrium. And then you can solve for this enclosed form, and pretty much this is what you get. And then you can see how does it depend on the different ingredients in the model. And in particular, we're interested in how theta star depends on omega. Basically, if you compute the derivative with this with respect to omega, you find that it's positive, right? Again, for a given deposit contract, right? So R1 and R2. They're not endogenous, here they're exogenous, right? So that means this direct effect says for fixed deposit contracts, more CBDC remuneration makes the banks more fragile, again, because it's more attractive to run on the bank relative to worlds without CBDC. Okay, then we need to solve for the bank's deposit contracts. In order to do that and taking fragility into account, so basically what we need to do is we need to solve the bank's profit maximization problem. So the bank invests in that project, it makes R theta, and it pays R2 on deposits, and all of that is only read conditional in case that the bank is solvent at that, right? So we have an assumption that there's no banks. Importantly, this profit maximization problem is subject to an investor participation. Right? So basically, in order to attract deposits at t=1, the bank needs to promise a payoff, at least in expected terms, that exceeds whatever consumers can get from just putting their money directly into CBDC, right? And so basically that means through CBDC, so if this omega is greater than 1, this means the bank faces somehow a competitor, right? Out there is CBDC, and in order to persuade depositors to put their money not into CBDC, but into the bank needs to offer a higher return, right? And then we make some assumptions on the parameters, and then basically we can solve for the optimal deposit contract and particular, what these assumptions do is they ensure that the deposit rate comes from the participation constraint, which is the binding equilibrium. That basically means short-term deposit rate is equal to 1, and the long-term deposit rate is such that an increase in CBDC remuneration forces the bank to offer a more attractive deposit contract, right? So you can see it immediately here. Suppose the participation constraint is binding, then we would have an inequality here. And then if I increase the right-hand side, I make CBDC more attractive. I also need to offer a more attractive deposit, right? And so then we can put these two things together. We can compute the total derivative. We have the direct effect, which is positive, and then we have the indirect effect, which is negative. Then we have some conditions, which I can skip in the interest of time, but we put it together. And so basically, this is what the headline result that we find, right? So there's these two effects, they go in opposite directions, and so for low omega, the beneficial effect on financial stability dominates, and for high omega, it's the negative effect, the maybe runs more like of the data. How many minutes do I have now? Like three. Very good. So then I can talk 2 minutes about CBDC design before wrapping up. So one thing we try to look a bit more deeply is into these holding limits, because that's a bit of more active policy debate. So should policymakers restrict the ability of consumers or investors to hold CBDC? And so this is exactly what we do here. So basically we impose holding limits by assuming that investors can only hold a fraction gamma, which is less than 1 of their wealth in CBDC. So what that immediately tells you is that this reduces the effective outside options, the outside option that consumers have, right? Before you can withdraw all your funds into CBDC, now you can only withdraw a fraction of the fund in CBDC, and the rest you must withdraw in cash, right? And so on cash, you don't get any remuneration. On CBDC, you get omega, and so the higher is this holding that is gamma, the lower is the effective outside option, right? And so you can see it quite nicely in this graph. That so you have the solid line, which is the headline graph that I showed you in the previous slide. So now, if we introduce these holding limits, what it basically does is that for each increase here on the x-axis of omega, well, you have a 1-for-1 effect in the baseline model, and you have a weaker effect than with holding limits, right? So if I increase the CBDC rate, and there's holding limits, there's limited or constrained pass-through in terms of the outside option, and so that pushes everything to the right. And so from policy perspective, that means, well, the effect of this holding limit policy on financial stability can also go either way, pretty much like the baseline effect, right? So if you impose holding limits and you're on this downward sloping part of this parabola, then actually holding limits can be counterproductive because it would be socially beneficial, to increase CBDC remuneration even more. While on the other side, if the rate that you set is too high from a financial stability perspective, then you can use the holding limits to sort of correct this excessively high CBDC rate, right? And of course, the idea behind it is that maybe central banks may set the CBDC rate for financial stability purposes as sort of the first objective, but maybe it's rather dominated by monetary policy perspectives. And then these holding limits, under some conditions, basically if it's too high, they could help safeguard financial stability. Good. Since there's 1 minute, let me read the slide very slow to conclude. So I have a parsimonious model on financial stability implications of CBDC. The model has a few attractive features. In particular, you have this endogenous probability of bank runs, and you can study nicely how CBDC works, both directly as well as through the deposit contract set by the profit maximizing bank on financial stability. And we have these two countervailing forces, direct and indirect effects, which says that it's the overall effect is ambiguous, and policymakers want to have these countervailing effects. Banks don't live in a vacuum into account when deciding what CBDC remuneration, if they decide to do so, right? And then we also have some implications for design, but okay.
I will discuss this paper. So, first thing, oops.
My bad.
First thing to say, I think that the paper starts with a very important research question, that is the business effects of CBDC for financial stability. How do they address the question? They use a model of financial communication with bank run, and they try to link how CBDC remuneration will affect the probability of bank run. So they have a remunerated CBDC, and they are kind of vague about what this remuneration is. And I think that what they have in mind is a mix of a possible interest rate on CBDC, but also some benefit that the households can get from the CBDC, so some kind of convenience yield. And what they do, they find this example probability of bank run that they use to measure for financial stability. And the main result is what we saw before is this U-shaped relationship between the bank fragility and the CBDC remuneration. So I think this was very interesting. But then I started thinking, so what we already know from the literature about CBDC and bank stability, and there's actually a lot of paper that he also mentioned that try to relate the two things. And in particular, we have some papers from Fernandez, Verde, and all his co-authors that they have these theoretical papers that say that in times of crisis, the central bank could arise as a monopoly. So you had like this huge bank run in terms of crisis, and then you cannot have run anymore because you didn't just have the. And on the other paper, they say, okay, this dilemma, and then if we want to commit to price stability, then there's the possibility of run on the central bank. And of course, you cannot have a real run on the central bank because the lady of the central banks cannot be redeemed. But what they intend is that maybe you have a collective spending. So, and then I don't want to spend much time on the literature, but there are other papers that can say, okay, if we properly design this, see that maybe we can reduce or even we can control the threat to financial stability. And in particular, I think it's very nice because from Graham-Meyer and Nitzan that they say if we introduce central bank pass-through funding, that means the central bank is going to compensate commercial banks for the loss in deposits. Then we have this circular redistribution of funds, and then we don't really have real effects for the economy and therefore more people. What is really particular of this paper in the literature is that they really pins down the probability of bank run. So they really link the CBDC remuneration with the probability of bank run, and to the best of my knowledge, they are the only one who do this. So this is the graph that we saw before. So why we obtain this U-shaped relationship, we have two effects. One direct effect that means what they find is that if we increase CBDC remuneration, what's going to happen is that at the time of run, my alternative outside of the bank is more attractive, so I'm going to run away from the bank, and therefore I'm going to increase the bank fragility, the bank fragility because of this effect. The other effect is indirect. It's maybe it's what's really new about this paper is that okay. As a bank, I know that they are going to run as I increase CBDC remuneration. So what I'm going to do, I'm going to propose a contract that is more attractive. And in their case, it's like we're going to increase the interest rate that we are going to offer in the long term. So in the times when you have to decide whether to run or not, if your alternative inside the bank, so means not running, is attractive, that you're not going to do so. So this effect is going to decrease financial bank fragility. So we have these two opposite effects, and given which one is going to win over the others, then we get the U-shaped relationship. Then, what if we introduce CBDC holding limits? As Peter said before, it's kind of a very important question because a lot of central banks are addressing this issue. right now. What happens is, of course, in the moment that you have to decide whether to want to run or not, your outside option is less attractive because the alternative, if you're running, you either choose between CBDC or cash, and cash is not remunerated. So everything is kind of delayed in terms of CBDC remuneration. And finally, I think it didn't have time. I think this was very interesting. It didn't have time to present it. Is that if so, this U-shaped relationship really happens when the bank is a monopolist bank, but then if we decrease the market power of the bank, we're going to lose the direct effect, and we have only the direct effect because like what I was expecting at the beginning. So it's really, I think it's important to say that this indirect effect is given by the monopoly of the bank. So overall, I think it's a very good paper. It's interesting. It's relevant. They highlight a new economic mechanism for the interaction between the CBDC and bank fragility that I think is very important. The results they get, from my point of view, have huge policy implications, and I'm going to come back to that in a slide. And it's really well done. So while I was reading the intro, I was like citing all the questions, like I'm going to check this and that, and they addressed all of that. So math checks out. They distinguish between liquidity or solvency crisis for the bank run. They talk about the fact that if you increase interest rate in the first place, then probably you're going to increase also the probability of being insolvent at the end of the period. They also talk about the incentive for bank deposits in the first place when you begin with. So I was thinking, how can I discuss the paper when everything checks out? So I've been a bit more creative, probably. So I was looking at the results and comparing the results with what central banks are actually saying or trying to do, and what central banks are going in a direction with very little or no remuneration at all. And what I was thinking is that if we are in this regime, if central banks want to go in this regime, even the results that they get, it seems like it's not going to be optimal, at least in terms of bank fragility. And if on top of that, we also add holding limits to non-remuneration, we're even worse off in terms of probability of the bank run. So maybe you're not in the digital euro project, but maybe you want to talk with your colleagues and chat about it and try to discuss. I don't think, as a member of ECB, I don't think you can put like a paragraph or discussion in your paper, but maybe you can talk with your colleagues about that behind doors. But then, like, if we have indeed this direct effect, I think that also very useful if we can quantify the magnitude of this indirect effect. So maybe you can try to calibrate, maybe you did, but so you use like these, I think it was R equal to 15 or something like that, that I really didn't understand where it came from. So maybe you can explain it, or maybe do some robustness checks to understand whether this effect is rather big or small. And once we have a very good calibration of this, we can maybe answer the question: can we effectively reduce the probability of bank runs by increasing the interest rates of the deposits? And what's going to be the effect, or how much should we in sense of banks increase these interest rates? So maybe also looking at the interaction between CBDC remuneration and how much banks optimally increase this interest rate will be interesting to better understand these economic metrics. And very quickly, I have like another model. It's not for advertising, but we kind of calibrate the model, and it's just to say that we obtain something that goes in the direction of your indirect effect. It's not really the same because we don't look on financial fragility, but we find that if we increase CBDC interest rate, that there's some willingness for the bank to actually increase interest rate and compete with the central bank to retain deposits. However, what we find is that this willingness is rather small. Now, the scale is not perfect, but it's rather small. But I have suggested that if we introduce customers heterogeneity, then his willingness to compete with the central bank, at least in our model, increases a lot. And like how we do it, like this heterogeneity in our case is heterogeneity in how much I would like the CBDC. That it's not going to be the same for old people, young people, people that discuss central banks, etc. So you're going to have this, and the bank can actually play with this preference, and since it's going to play with this preference, it's going to it could increase more the interest rate. So my intuition is that if your research is true, mine kind of have some value behind, that maybe what we can find in your model is even a stronger effect on the bank fragility, especially in the first rate. So overall, good job. I think it's crucial to understand the magnitude of these effects for better design CBDC in the future. So I think, of course, it's going to be relevant. But of course, it's being, it's better than it's a very relevant research question.
Great, thanks so much, Martina.
Many thanks for Jill and Leonello for including our paper in the program. It's very pleasure to be here presenting on what kind of investing in bank lending technology, understanding it. So this is a joint work with Zhiguo and other students. So over the past 2 decades, information technology has gone through a rapid growth, and as a special producer, the producer of loan in the economy, the information has always been at the center of banks' loan production function and banks lending skill. So it's very natural to ask, how has banks lending technology been affected by the arrival of the information age? And by banks lending technology, we're referring to these 2 types of skills. The first is the production and transmission of stock information, and the second is the processing of hard and ready to use. So the main goal of this paper is to provide an anatomy of banks' investment in their lending skills, these pickup skills and for lending technology, to phrase it in paper in the information age. And to do that, we first provide a description and documentation on how banks' understanding has been evolving over time and exceptionally. And second, we provide causal evidence between information began embedded in different types of loans and bank lending technology adaptation through looking at how they make investment in different types of IT habits. So we try to make 2 contributions. First, there has been limited knowledge on how banks make IT investment and how does that connect to their lending activities. And second, there has been limited evidence on whether and how financial institutions may causally adapt their lending skills in response to credit demand changes that are embedded with different information nature. And we try to fill these 2 gaps. Okay, so I will skip the outline. So to do that, we utilize a unique and novel data set from Aberdeen, previously known as Hard Hence. So this is the randomly establishing level data of the establishment's IT spending, and we use the data from 2010 to 2019. So this data set covers the more general, all the industry categories, but we are more focusing on the banking sector. So the feature of this data is that it provides detailed categorizations of different types of IT spending. For example, hardware, software, communications, services, and etc. It also has information on IT related employees at the establishment level. So we are one of the first paper in the literature to study how banks make IT spending, and in particular, we are trying to stress its contribution. We're trying to make contribution by building the linkage of IT spending to the information acquisition embedded in different loan types with different information verification. So this data has been utilized in previous works. For example, AER 2012, a Hoffmann study the effect of internet on labor wage, and Bloom et al. Management Science 14 studying the IT impact of IT on intra-firm control. Okay, so some coverage, sample coverage. So our data covers the total asset size of banks. Our data set covers 80% of the total asset size of the whole U.S. banking sector. And the data covers bigger banks very well. The smaller banks coverage is much more smaller. But for the medium-sized banks, the coverage is pretty decent. So in terms of the measurement, our current sample in the current version, our sample. The IT spending over operating income in our sample has a median of 7.1%, which is broadly consistent with some industrial and consulting reports. For example, McKinsey in 2012 having a on average IT spending over expense between 4% and 9%. So notably, IT spending as a share of interest expense has been as high as 40% in 2016, which really signifies that IT expenditure is very, very important kind of input in the business banking sector. Okay, so broadly speaking, we're undergoing a dramatic review, and as far as it's not updated yet, but broadly consistent with some other works, we find that over time, larger banks are steadily increasing their IT expenditures over time, but smaller banks are falling back, especially after 2015. So for the rest of our paper, and due to the focus of our paper studying information nature, different information nature products actually banks investment in technologies, we're going to focus on these two specific categories of IT, communication and software. And we'll explore I'll explain more about that in that couple of slides. Okay, so this is a snapshot giving you some representative examples of these two core types of IT software and communication. For example, software can include risk assessment tools, credit scoring software, application processing software, etc. For communication, they can imagine video conferencing tools, private branch procedures, etc. So there is a more detailed list of these categories, the items inside these two categories in the appendix of the paper. Okay, so what we have for the economics of banks' IT spending. As I have listed at the beginning of the talk today, so banks' lending technology hinges on two different types of abilities or skills. The first is the gathering and transmission of the borrower's information, and this is particularly true for the stock and new information about the borrower. And this is highlighted in slide 2002. And the second type of ability is their ability how well they can process the hard and ready-to-use information. Right? So this, you can imagine this kind of information is really already out there. It's already generated. You can just throw them into the algorithm to calculate a metric for your decision. So our goal is to study the economics of bank IT spending in the context of how they are adapting these two types of skills. So what we do is that we start with examining how bank's IT investment profile is related to the bank's loan portfolio structure. This is because loans use information as input, and loans themselves are output of the bank. You can imagine that. And by building this linkage, we will have a basic idea of which types of these IT categories, which categories of these IT spending is more associated with these two kind of distinct skills. And after building this linkage, this correlation, we provide causal evidence in identification framework to study whether when there is a credit demand change that's embedded with different information nature, banks will also accordingly causally adjust their IT investment profile so that we can make causal argument that these two skills different causally. Okay, so here's what we find for the first part, for the correlation part. Okay, so broadly speaking, we find that CNI loans are positively associated with communication, but there's no correlation between CNI and this software. And specifically within the CNI loans, we find that small business loans, which I will just term it as CRA, is particularly positively correlated with communication. So if you think about what's the feature of small business loans, these are the loans that are, coming from very opaque borrowers, which are very soft information intensive. So this tells us that soft information, skills to deal with soft information is pretty associated with how banks, whether banks are spending more on communication. Or communication spending is more associated with whether banks are trying to deal with soft information. And similarly, when we go to the personal loan, what you find is that personal loans are broadly positively correlated with software spending. And interestingly, if you look at the big categories of personal loans, you will find that mortgage refinance stand out. That's the number one pusher inside this category. Which shows that mortgage refinance strongly correlated with software spending, but there's no correlation between mortgage refinance and communications. This tells us that mortgage. So if you think about the nature of mortgage refinance, this is a very hard information to test, right? So for refinance, you already have the loan, have the property, and you have your repayment history. So what loan officers they will do is just throwing all of this information and then calculate some decision. So this tells us that software spending tends to be more correlated with hard information processing. So this is the big picture findings we have in the correlation part. There are some other interesting features we got from the correlation part. So for example, we find that banks with more complex hierarchical structures tends to spend more on communication. And also banks who are more frequent lead banks in the syndicated loan market are also spending more on their communication spending. So furthermore, we find that the positive association with small business loan, CRA, and communication spending is monotonically increasing with banks' complexity in their hierarchical structure. So this is the direct test of SCI 2002. Okay, that's all for the correlation part. So what we have for the identification part, so we want to find two demand shifters that that drives these two specific categories of loans that are first one is soft information intensive. The second one is hard information intensive. So the first demand shifter we got is for a demand shifter with small business credit, and the event we're utilizing is a small business health options program in 2014. So basically, small businesses fewer than 25 employees are qualified for a employee health care package tax credit of 35%. And after 2014, there's a jump. So this credit increased to up to 50%, but only for the qualified small business. So the usefulness of this event is that this event has asymmetric impact on credit demand in the local market. It will directly induce local small business to apply for more small business credit. But in the meantime, there's no direct impact on local mortgage refinance, which is something we really want. And so utilizing this and also utilizing another important feature is that there's a huge rich geographic heterogeneity in terms of each location's exposure to this event, because different counties, the share of local small business that's qualified for this program is dramatically different. So we employ these two crucial features of the event, and utilizing this share of qualified small business as the ID in this different setting, we find that in places where we have higher shares of qualified small business, indeed saw a much faster growth in the small business credit after the policy event. And then accordingly, local banks residing in these locations dramatically increase their communication spending, but with no response in their stocks. So quantitatively, one standard deviation in the small business loan growth is translated into 0.7 for one standard deviation higher in the communication growth, that's amounting to around $700,000 per year, which is really huge. And in this overtime diagram, we divided samples into two terzols. And so we try to with the top terzol being those with counties with high exposure to the event in terms of the share of qualified small business pre-shock. And we compare the communication and software over the whole event window. there's no pre-trend in between the high exposure counties and low exposure counties banks in terms of their communication and software spending. But after this event, there is a dramatic increase in the communication spending in the high exposure counties compared with the low exposure counties, because there's still no difference in the high exposure and low exposure counties software spending in their local banking sector. Okay, so that's the first event. And the second event, we're trying to utilize a mortgage refinance event shifter. So what we use is utilizes the low interest rate episode during 2010 and 2015. So the idea is that during this episode, existing homeowners will have different degree of incentive to propensity to refinance their mortgage. This is because in this episode, the mortgage rate are across the whole nation is uniformly low. But before this episode, in different areas, the local households mortgage rate are substantially different. So we calculate the payment gap as the mortgage total repayment of the local household under the old interest rate and compared with the total repayment under the new systemically low new interest rate. And you can understand this payment gap is potentially a payment savings if they try to refinance. And we utilize the cross-county differences in the pre-low interest rate episodes interest rate mortgage rate. Because this is useful because these mortgage rate pre-low interest rate episodes are predetermined, which is not correlated with the current local economic conditions. So that's our identification assumption. And utilizing this IB and in the two-stage experiment framework, we find that in places with higher payment gap, potential payment savings, households do indeed increase their mortgage refinance substantially more compared with origination, and accordingly, banks located in these counties substantially increase their software spending, but there's no response in the communication spending. We use this identification framework. So one standard deviation increase mortgage refinance translated into 0.419 standard deviation increase in software spending that amounts to about $1.33 billion. Okay, so this is the overtime diagram. We don't have data before 2010, so we normalize everything at 2010 and show that there's a difference in the high refinance propensity counties IT spending in software and for the high exposure counties compared with the low exposure counties, but for communication there was no such difference. Okay, so what's the last part of our paper? A specific phenomenon of the information technology development is the emergence of fintech. So fintech sectors are fintech companies. They're very specialized in dealing with hard information because they're all algorithms software based. So broadly speaking, if you look at the conception of it over time, you do find that banks located in the high fintech presence counties, they do tend to extend more than their two lines. But what we are more interested is more rigorously ask the following question: how do commercial banks adapt their lending technologies when fintech lenders penetrate into the local credit market? The theoretical prediction is very unclear because it can go either direction. First, concerning of the winners curse, they might fall back because they know that there's a new lender more specialized in dealing with card information entering, so it might fall back. But on the other hand, they might also catch up if they really want to compete and protect their business shares. So it's really an empirical question. So we ask, do banks react in their IT spending when fintech penetrate, and how do they react in different IT categories? And also, do large and small banks react differently when there's a fintech entrance? So here is so to do this, we utilize the staggered entrance of lending club to 9 states after 2010 as our identification framework. So after 2008, 9 states, lending club staggered entered into 9 states, which gives us a framework to do this identification. This is the list of the states we're covering because our data only start from 2010, so we exclude the 2 states that has the lending club approved lending club in 2010. So what we find is that After the fintech entrance, banks tend to systemically increase their software spending, but there's no reaction in communication or even a slightly negative reaction in their communication spending. And more interestingly, we find that these higher growth in this response is particularly driven by larger banks. So larger banks react very aggressively in software spending, and they're even decreasing their communication budget. But for smaller banks, after intervention, there's literally no response. Okay, so this is the overtime diagram showing up what's happening after the fintech entrance. We see that there is a significant increase in software spending, but literally no reaction, no pre-trend in communication. Okay, so it's time to conclude. So this is study, we studied banks at lending technology development in information age, so we're looking at how they spend in different types of IT. So we demonstrate that the economic mechanism behind the bank's IT investment and relate that to the information-driven lending technology. Right? So communication technology is more associated with production and transmission of soft information, while software is more associated with the processing of the hard information, system information. And moreover, we identify that when there is a credit demand change embedded with different information nature, banks will also causally adapt different lending skills to spending this paper. I really enjoy reading it. But before I start, I just want to mention that those are only my views, not the Federal Reserve Bank of Ghana and the Federal Reserve. Okay, so let me start with. Okay, sure. Okay, so let me start with a quick overview. The paper explores our bank and their lending technology, and they find that investment in communication IT, which is one part of the IT spending, associated with improving banks' ability to produce and transmit soft information, which was explored using small banks activity. And investment in software IT helps enhance bank hard information processing capacity, which was explored using mortgage lending. They also find that banks adopt different types of lending technology in response to credit demand shocks with different information nature. And the last conclusion was about the entry of fintech companies that induce commercial banks to increase their investment in IT. So I want to go quickly about the motivation as I see it and the contribution of this paper. So in general, the financial services industry is increasingly becoming a tech-like industry. However, there are still many open questions about the effect of IT spending in banking. Basically, I was super surprised that there are only a few papers that explore the IT spending in recent years, and even like finding information on the website about IT spending is very rare. Especially, there are some questions that can be asked about IT spending by bank side, by type of credits or mortgages, consumer spending, small banks, etc., smaller companies and spending by state, by type of institution. So there are many questions that can be asked about IT spending. Also, question about IP and hard versus soft information, and the effect of existence of fintech companies on IT investment in the banking system. As I mentioned, there are only a few papers that explore the IT spending over time, especially in recent years. I tried to find information on IT spending in the banking system and in general the financial system online. There is some information, but again, it's very rare. This figure shows the increase in IT spending by the banking system worldwide over in recent years. You can see that there was a huge increase. I guess that it's related to COVID and fintech. But I can also share some information that JP Morgan spent in 2022 more than $12 billion on new technology on IT. And now Goldman Sachs and JP Morgan are declaring themselves as technology companies with a banking license. So there is a shift in banking strategy. And the big spending on IT reflects the pressure
on banks to compete with fintech companies. Overall, what I can conclude that there is a large space in the literature to contribute to a better understanding IT spending in the banking system. And as I mentioned, only few papers ask similar questions. So the contribution is super relevant. I think that the main contribution of this paper is about the data. They use information, data on bank IT spending from 2010 to 2019, covered 3 million observations and includes more than, let's say, around 2,000 commercial banks in the US. It covers more than 80% of the banking sector. The software is more representative of large banks, which I didn't think that's a huge issue in terms of a sample selection. And the IT spending as a share of net income ranges from 2% to 14%. And the median IT spending in their sample as a share of net income is around 7%, which I thought is a small number. I know, like, I guess that some of you can agree with me that if you would think what's the share of IT spending of net income of the banking system is supposed to be higher, sometimes, as I'm going to show you, that higher number. Now, this is only one part of the data. They merge the IT data with a lot of other data sets. This is amazing, the data report here. I'm not going to elaborate more about the matching here, but they merge this IT data with low-level information from first bank balance sheet or report, using information on net income, and deposit and ratio of assets. They also use information on loan and local characteristics. As I mentioned, they compare small banks lending and mortgages, and bank geography structure, which includes the location and industry classification. So a lot of data work. So if I need to conclude the contribution of this paper, is the definitely the topic, the research question, and the data are amazing. I have only a few comments. The first one is about the IT spending. So this is a figure from the paper. The numbers seems very small, as I mentioned. They compare their numbers to McKinsey report from 2012, but it seems like a very old report. I would try to find like more relevant reports. And one question that I had in mind to like reading the paper is what is the country factual? So what should be the share of IT spending with no changes in data, only due to some improvement in technology? So what should be the baseline estimation of spending on IT in the banking system? This is a figure from Jones' paper that basically shows that on one end there is computing efficiency that has risen over time, and the cost of storage has declined over time. So there are a lot of things going on during the same time. So in order to better understand IT spending, I think that we need to understand the different components of IT spending that can be shown in this figure, but there are also other sources of information. The second comment is about IT spending by category. So Sheila showed this figure, which is the share of IT spending by different sizes of banks. So you can clearly see that big banks are increasing their IT spending, and this is not the same for small banks. But the main question is what are the reasons for that? So the entry of fintech companies doesn't explain much of the changes that we see here between big and small banks. Some possible explanations which I think we should explore is that maybe big banks are outsourcing the IT holding structures, or maybe they're purchasing some IT companies or fintech companies. What I think is important is to show the same figure by different types of credit, so mortgages. So there is, I think, one competing paper that shows that fintech lenders' share of US mortgage lending increased from 3% to 15% in the last decade. So I think that there is large differences between different types of credit. As you show in the paper, IT spending in large banks is growing, but there is no such growth in small banks. But there are a few potential concerns in the identification. One concern is that IT investments are also correlated with other bank characteristics, so not part of the sample, omitted bias. Another concern is banks which are more exposed to competition of fintech, let's say ex ante, also end up adopting more IT. And the relationship could be because of causal impact of fintech exposure on then IP, or because of correlated factors such as I think about location that can affect exposure to fintech. I have some suggestions here. One suggestion is to use more local analysis or within state analysis. Another suggestion is to use value requirements for the bank, for big banks in exposure to fintech. The last comment is about other channels. I know it's annoying to suggest more things to do because you already done so much, but maybe it's for a follow-up paper. There is a nice working paper about the effect of fintech or exposure to fintech on the number of ventures. There are other like potential mechanisms or other channels that IT spending can affect other outcomes. So for instance, like the changes in the number of branches, which can also like affect lending to different households, like older households compared to younger households. So I think we can explore like screening borrowers by their characteristics. Another potential that's it, like that's my another like potential and I think very important effect of exposure to IT or IT spending is discrimination in the mortgage market. I think about robots compared to mortgage officers, and if investing in IT promotes financial inclusion. So overall, I think it's a very interesting paper. I really enjoyed reading it. I think it's amazing data and interesting results, also policy, both for research and comments, but I really recommend you to read the paper. Thank you very much.
So thanks, Xiong and Leonello for organizing this amazing session. So our paper is about big tech lending model. This is joint work with Lei Liu and Wei Xiong. So our paper is really motivated by the entry and fast expansion of big tech companies in the lending market. Well-known examples include Amazon in the US, Alibaba and Tencent in China. So by 2019, the total credit volume provided by big tech companies was almost twice as large as the combined total credit volume provided by all the other type of fintech lending companies. And this is not only a US or China phenomenon. From this table, you see a lot of countries, including Latin American countries, Southeast Asian countries, and East Asian countries. They all see presence of big tech lending. So big tech lending is likely quite different from the other type of fintech lendings because the big tech lenders are integrated into the big tech companies' ecosystem. So they enjoy the brand name, information advantage, and probably some monitoring advantage as well. But so far, there's little direct evidence on the performance of big tech loans, mainly due to data limitation. So in this paper, we compare the business loans to SMEs by a big tech lender versus the big tech business loan also to SMEs by traditional banks. And we assess their performance in general and in particular over the COVID-19 period. And we also try to study the likely mechanisms that contribute their performances, and also including what probably borrowers use a big tech loan for. So what we find that the big tech loans were not excessively risky, even though it is lent to borrowers with much worse credit quality. And also it is robust to the COVID-19 shock in the sense that the overdue risk of loans by big tech lenders after the shock didn't increase as much as the overdue risk of loans by traditional banks. In terms of mechanisms, we find that the big tech borrowers tend to repay really fast, far before the maturity of the short-term 1-year loan, as you will see in the data. And this indicates that they probably use it for satisfy their short-term liquidity need instead of expanding their business. And we argue the high interest rate and convenience feature of the big tech loans help the big tech lender to attract such borrowers with short-term liquidity demand. Because with high interest rate, it only makes sense if you borrow it in the short term. Otherwise, the cost is so high. And only the high interest rate is not enough, because otherwise it will fall into this classical adverse selection story. So you need some additional convenience so that you don't attract borrowers without alternative credit. And we also show that standard mechanism like information and monitoring may probably work as well. So our big tech lender is MyBank, which is the largest big tech lender in the world, had lent to over 35 million unique SMEs over time by 2020. And it is a subsidiary of Ahnert Group, which owns Alipay. And also Ahnert Group is in turn a subsidiary of Alibaba Group, which own the e-commerce platform Taobao and Tmall. Most borrowers are either merchants of these big tech lenders are either merchants using Alipay or vendors on Alibaba's e-commerce platform. And through this ecosystem of the big tech companies, they have extensive information about borrowers, as John's research also shown. They have information about their cash flows and cash flow along the business chains, etc. And they also have some monitoring advantage in that they can identify what your borrowers really use a fund for and terminate the loan if they find that they are not using the loan for the stated purpose, and also they can monitor the repayment. Another salient feature of this big tech lending is that it is extremely convenient. It operates in a 310 mode, 30 minutes application, 1 second approval, and 0 human intervention. So this is the background of big tech loans, but the big tech lender is constrained in funding. So actually, the majority of the loans are done through its syndication with traditional banks. And our data actually comes from one of its major and representative co-lender we call Bank X. In this syndication, MyBank is responsible for acquiring customers, processing loan applications, setting interest rate and credit limits, and chasing after borrowers if they default ex post. The main function of Bank X, that traditional bank, is to provide funding, and it provides the majority of the funding. It can reject loan applications, but it doesn't determine the interest rate or credit limits. Bank X itself is a large commercial bank with national coverage in China. And besides its syndication with MyBank, the big tech lending, it also has two of its own loans to SMEs. One is the regular loans, which just done through the loan officers, and it takes 1 week to process the loan application. And the other type is online loans. Essentially, it's fintech loans of its own, where borrowers can apply online, and Bank X use some alternative data and also the data that it has on its own to process loan application. But nevertheless, it still takes about half a day to process, to approve the credit limit or obtain the loan. So our data include 10% of random borrowers that borrow through either of one of the 3 lending programs: the big tech loan, which is a syndication between Bank X and MyBank, the regular loans, and the fintech loans of Bank X. Okay, and we also have a sample of borrowers that borrow both big tech loans and the Bank X loans at the same time during our sample period. And we call this overlap sample, and we will use it for later analysis because it better control for characteristics. And let's first look at borrower characteristics. From the table, you see that more than 80% of big tech borrowers got their first ever business loan in their entire life through the big tech lending program sometime in the past. And the number is much higher than the corresponding numbers from Bank X lending programs. That indicates that the big tech lender is really developing new borrowers unserved or underserved by traditional banks. And also from this table, you see the amount of alternative loans that borrower has, except from the Bank X or My Bank. And you see the loan amount for big tech borrowers are much smaller, indicating that they have limited credit access, or in other words, consistent with the last table, they have worse credit quality overall. And here is the basic loan characteristics. You see that most of big tech loans are uncollateralized. That's why our analysis will focus on uncollateralized loans. And also you see that big tech loans tend to have much higher interest rate, much smaller credit limits, and much smaller loan size. But nevertheless, they have similar maturity, and on average is about 10 months. So maybe it consists of loans either of 6 months or 10 months. That's why you see the number. Now let's turn to our first main table about overdue risk. We measure overdue risk by whether a loan was at least 30 days overdue exposed after loan origination. Unconditionally, you see that the big tech loans have much higher overdue risk compared to Bank X. But recall that the big tech lender was really developing new borrowers. So we cut the sample by whether the borrower has past lending record from the corresponding lending program, and you see that indeed a lot of big tech lenders borrowers are new borrowers, and the risk really concentrates in this segment. And when you look at the borrowers with some payback record from the corresponding lending program, the overdue risk was actually similar. And in the regression, if we run unconditionally, we see as just a summary stats, we see that the big tech loans have higher overdue risk. But as long as we control for basic characteristics, most importantly, information about big tech, the borrower's lending record, then we see that the big tech lender actually has even smaller overdue risk. That is in this sense that we say that the big tech lending is not excessively risky. Another issue that people care about is its performance over the COVID-19 period, which would create some structural break to the algorithm. And we worry that the big tech lending just doesn't work. And first we see the credit supply, and the red line is the big tech loans, big tech lending. And you see it is pretty stable. If anything, we see some drop from big Bank X regular and online loans. And in terms of the overdue rates, we look at whether the loans originated immediately after COVID-19 shock had increase in credit overdue rates. And the key coefficient is this interaction term between the big tech indicator and whether the loan was originated immediately after COVID-19 shock. And see the negative coefficient indicate that the overdue risk of big tech loan didn't increase as much as Bank X loans, suggesting that it is robust or adjust very fast to the COVID-19 shock. This is kind of in sharp contrast with the finding from the fintech for the other type of fintech lending, where you see that it is not so robust to the COVID-19 shock. So far we show that the big tech lending seems to manage the risk pretty well, even though it is covering segments of borrowers with worse credit quality. So next we look at the possible mechanism that can contribute to its performance. And we argue that several mechanisms may be at work at the same time. The first two are the information and monitoring, which is the traditional mechanism. The second and third one, the convenience and high interest rate, which we argue is kind of particular to this big tech lending, and it helps the big tech lenders to spring borrowers with short-term liquidity demand. Because the payback time is really fast in that case, then it protects the big tech lenders from exposure to borrower risk. And for the first two, we first follow Chipotle and Salini to do this correlation test. The idea is that each lending program has some credit limit, and borrowers can determine how much to use within the credit limit. And if there is a correlation between the indicator of using up credit limit and ex-post overdue, then there's some adverse selection or information asymmetry going on. And so we test this conditional correlation between this using up a credit limit indicator and the overdue indicator ex-post, conditional on all observable loan characteristics. And if anything, we see a negative coefficient for the big tech lending program, indicating it may instead have advantageous selections instead of adverse selections. But we see some possible positive correlation for the bank X regular loans, indicate some adverse selection there. Another thing that we examine is a repayment pattern. Because the loan maturity is pretty short, either 6 months or 1 year, if borrowers use it for business expansion, it is unlikely that they repay the loan earlier than that. But from this table, you see that this table is about the ratio of payback time to the scheduled maturity. You see that the number of big tech loans is much lower than the bank X corresponding loans, indicating that they are really paid back really fast. And actually 5% of them pay back on the same day. That's why you see 0 there. And 25% of them pay back 4% of scheduled maturity. For 6 months long, it's just 1 week. And 50% of them pay back in 28% of time, just 6 weeks. So with such short payback duration, it's unlikely that they use it for business expansion. Instead, they are more likely to use it for short-term liquidity demand. So what's going on here? So if we use it, do the same analysis in regression, not surprisingly, you see the similar pattern. And this short-term liquidity demand and short pay duration protect the big tech lenders from exposing to the borrower risk. So what's going on here? Recall that big tech loans have high interest rate, right? So it only makes sense if borrowers borrow it for short term, for a short term. If they borrow long run, for example, even 1 year, the interest can be as high as 20% sometimes. So it doesn't make economic sense. And in this case, in this way, it's select borrowers with short-term liquidity demand. But again, the high interest rate alone is not enough. You need some other features so that it doesn't adversely select people. And we argue that the convenience of big tech loans is one of the features that save the overall cost of borrowers in every time borrowing. And you see that on average, borrowers frequently borrow and repay. So that also reflects the convenience feature of the big tech lending. So as I mentioned, there's one sample of borrowers that borrow both big tech loans and at least one type of bank X loans over the sample period. And we first examined the characteristics of borrowers and loans over this sample. What we see is that surprisingly, we see similarly high interest rate, low credit limit, and low loan size for big tech loans, even on this overlap sample of borrowers. And also, borrowers tend to pay back really fast, and they borrow more frequently over the sample period for big tech loans. That indicates that the big tech lender is not competing aggressively with traditional banks over this segment of borrowers that potentially have access to bank loans. And when we wonder whether this is because you see this pattern because some borrowers first go to bank X and then they run out of credit limit and go to my bank, the big tech lender. But so we count the sample by whether a big tech loan sample by whether the borrower has cheaper and larger credit limit available at the time of borrowing from bank X. But we find similar high interest rate on both samples, indicating again that by review preference that they buy at higher interest rate, there must be something that they really like. And we think this is a convenience feature. And also by review preference, they must be the borrowers that care about this short-term liquidity demand. And indeed, you see that they pay back even faster than the overall sample of big tech loans. So at the end, we do some analysis on the overdue rates on these overlap borrowers, without controlling for a borrower fixed effect. We see that the big tech loans have lower overdue rates compared to bank X loans. But after controlling for individual borrower fixed effect, we see similar coefficient, indicating that conditional on the same borrower, they either default both or they don't default at all. And the difference mainly comes from the selection mechanism of the big tech lender. And interestingly, when we interact the big tech indicator with whether the borrower has alternative and cheaper credit available from bank X at the time of borrowing, the coefficient, the negative coefficient show that they even have smaller credit risk. Again, indicating that people who care about convenience and short-term liquidity demand actually indeed don't have much high overdue risk, and the selection mechanism actually works. At the end, we also show some correlation between whether the borrower default exposed on either of the loan and the credit and loan characteristic by each lending program. This is really about the selection or information of the different lenders. And we see that the big tech loans have much lower credit limit and much lower loan size if the borrower default on any type of loan exposed, indicating its advantage in selection. So overall, we find that the big tech loans are not excessively risky, despite that it covers borrower with worse credit quality. And a salient feature is that they attract borrowers with short-term liquidity demand. And also other mechanisms are likely at work. They are not competing with banks right now, but the future of competition may depend on the regulation, on the data sharing, and etc. Thank you.
So first of all, thanks a lot to the organizers for asking me to discuss this paper, which I enjoyed reading a lot. I learned a lot, and it's very interesting reading, which I recommend to everyone. So my name is Bertazzi. I'm from the ECB, and the usual disclaimers apply. So that's the outline of my presentation, but it's fairly standard. So let me skip. Actually, let me take advantage of the excellent presentation by Guangli. Was very clear to skip, the regular, let's say, summary of the paper. So maybe we say sometimes even also the end of a long day. Let me just go straight to the policy conclusions of the paper, at least as I understood them, because this is instrumental for what I'll be saying afterwards. So the first conclusion is that big tech loans don't pose financial stability issues. In particular, big tech loans are small, have a short maturity, very short maturity. Big tech lenders enjoy, say, of a strong trading capacity, and also benefit of an advantage of self-selection of the borrowers, which altogether this factor essentially limits the risk of these loans. Okay. The second policy conclusion that is reached in the paper, in review, is that the lenders support financial stability inclusion and complement instead of crowding out traditional lenders. This because big tech loans are used to address short-term liquidity needs only, so no investment, no funding of fixed capital investments. And also, big tech loans are addressed to borrowers which are unserved by traditional banks. In particular, SMEs with no credit history and lacking collateral. So overall, the paper is very, let's say, upbeat about big tech lenders, and all my comments will go in the direction of marginally, let's say, reducing this optimism on the big tech lenders, but only marginally. I guess the overall picture I buy. So general comments. First of all, it's a very clear paper, so it's easy to read, although it's a bit long. It's relevant, it's an interesting reading, and you know, as I said, overall convincing. So my comments will be in terms of, first, I will ask some, I will suggest some clarification on specific aspect of the paper. I will put forward some caveats on the interpretation of some of the results provided. I will provide some suggestions as long as I manage, and also some minor comments that I guess I will skip. So let's go on with the specific comments. The first one is about a potential, let's say, problem in the data, which I think would be has to be, let's say, explained. So first of all, there seems to be the case for a quantitatively relevant selection bias in the sample of big tech loans which are studied. This because the borrower characteristics, if I understood correctly, but again, maybe on this view, I will suggest more clarity. Borrower characteristics are derived from credit reports, and credit reports are available for 30,000 of the 140,000 big tech borrowers, so about 1/5 of them. Because these credit reports are available are those which are reported on a voluntary basis. So, of course, as long as the decision to report on a voluntary basis is not random, and you might expect it might not be random because if you have a bad credit history, you want to hide it if possible. Borrowers with worse credit history are more reluctant to be providing a credit report, and therefore this may induce selection bias in favor of big tech loans, which could blur the results. So this potential limitation is acknowledged, but then it's not clear to what extent is an issue or not. Maybe it is not. So I would suggest this move to address it. Second comment. So risk of big tech loans. So let me just let's say summarize with just the 3 numbers. So default rates, like summary statistic table, default rates for big tech loans is 2.6%, which is a kind of twice as large as the average for the other loans in the sample. So the loans extended by the traditional bank, both including regular and non-bank loans. So the paper is very convincing in showing that this higher riskiness is reflecting mainly a large share of first-time borrowers. Okay, and of course, first-time borrowers tend to be more risky because they are inexperienced, say, exposure, so to speak. So there is more risk there. And also, the paper shows quite convincingly that in the sample, the opposite holds if you control for borrower characteristics. So once you control for borrower's characteristics, actually the riskiness, the degree of risk in changing these loans is actually smaller. So based on this, thanks. Based on this, the hypothesis that big tech loans are riskier is rejected. Okay. So what I just wanted to emphasize here is that at least from a financial stability viewpoint, you don't care just about the relative performance, conditional on borrower characteristics of big tech lenders vis-a-vis traditional lenders. You care about the unconditional loan quality, because in any case these are riskier loans. So it's a segment which is more riskier, and it's a segment which is served by big tech lenders. So so this in my view is a big caveat. So what I would suggest to do here to build further the analysis and this normative assessment would be to conduct some analysis in the spirit of Yang or Ongen and Pedro paper in 2014, where essentially they check, they have an analysis where they check whether the markups, which are huge in this case, because interest rates are much larger than conditional loans, if these are commensurate to the much larger increase, so the increase in risk, because the risk is twice as large as we said. So relates to this a caveat is that these very large margins that big tech lenders tend to exhibit to benefit of, essentially could be mismeasured, could be subject to some mismeasurement, because this seems to be a clear situation of product bundling. Okay, so the big tech companies providing services on the e-commerce platform, and also the financial services. And of course, you can have cross subsidization. Then in the end, you don't know which is the price. The price should be assessed jointly, so to speak. Okay, I think it's clear. I'm running. You tell me, please, when you have 1 minute. Okay. So then, Porcellacchia test. So sorry for the very dense. Oh, let me skip this in 1 minute. I guess I want to go here. The mechanism. So the mechanisms that are put forward in the paper are the following: screening and monitoring. Okay. As I said, this suggests complementarities and bundling to be discussed at least anecdotally. No? So the fact that the big tech lenders is able to screen is because it can use this data from the e-commerce on about transactions and payments, etc. And this data supports its ability to screen and to assess credit risk properly. So there is this bundling complementarities, which I think should be discussed anecdotally. For example, you can check whether there are some special conditions on the e-commerce the trading platform if you have also if you're also borrowers or something. So higher interest rates. This is mentioned as a mechanism that supports the credit risk. Even if you have a high cost for these financial services, borrowers don't use it essentially. But to me, it's a bit confusing because normally higher interest rates should be treated as the endogenous outcome, market outcome, not really as a mechanism, not to explain the outcome of the market itself. So, and finally, convenience. Again, convenience is, I believe about this convenience story, but again, this goes back to this complementarity and product bundling story, which is, to me, a fundamental part of the whole narrative of the paper. So let me just conclude quickly on a suggestion on a different, might be plausible and alternative, if not complementary interpretation of the business model of big tech lenders, which is based on a more standard IO argument rather than a banking argument. No? So not really in terms of screening and monitoring, but it's more about in terms of cost structures. So we have a lot of elements indicating that this cost structure, the bundling of the ability to use this information is important. So essentially, what I want to stress is that it could be possible that for given funding cost, the low operational cost associated with big tech loans essentially allows the big tech lenders to extend loans to marginally riskier products. No. So, and therefore, even for given, say, screening capacity. Because of course the net present value, should take into account also the operational cost. This allows in particular the big tech lenders to experiment more first-time with first-time borrowers. Okay, and in turn, this would also lead to this higher rate of experimentation of first-time borrowers. Would allow dynamically to establish profitable lending relationships. And indeed, we have also some evidence about that, because we have a lot of first-time borrowers, but also have more frequent loans once you get the first-time borrower. In this classical spirit, we say, of the paper by Sharp, which is from 1999. So yeah, so overall, I think you have the tool and the data to establish, to analyze whether risky loans are profitable, first of all, or if they become profitable dynamically. So once they establish the relationship is established, and also what is the role of operational cost and ensuring profitability. This, of course, I'm assuming here that you have some information about the profit and loss of these big tech lenders, which I don't know, but this is something that you can maybe look for. Anyway, I'm done. Thanks a lot.
Thank you, Hugo, and you can give the mic to